Hey everyone, welcome back to Corporate Decoder, the place where we deconstruct the hidden stories within financial reports. And today we are diving deep into Avista Corporation's latest quarterly report. This is the 10Q filing for the third quarter of 2025, and let me tell you, this report has some interesting financial maneuvers and regulatory plays that we need to unpack. So before we jump in, if you appreciate getting straight insights from these dense corporate documents, make sure you are subscribed. And don't forget to join our Discord community, linked in the description below. It is the best place to connect with other finance enthusiasts and ask us anything. Alright, so Avista Corporation is an energy company primarily dealing with electricity and natural gas, and like many utility companies, they operate in a heavily regulated environment, which always makes for an interesting read in these filings. Let's kick things off by looking at their top line. How much money are they bringing in, and how is it shaping up quarter over quarter and year over year? For the third quarter of 2025, Avista reported total operating revenues of $403 million, that is up from $394 million in the same period of 2024. Now, looking at the bigger picture for the 9 months ended the 30th of September 2025, they brought in $1.431 billion. That is also higher than the $1.405 billion they had in the same period of 2024. So on the surface, revenue is growing, which is generally a good sign. But what really matters is the bottom line, their net income. For the third quarter of 2025, net income came in at $29 million. That is a nice jump from $18 million in the third quarter of 2024. And for the first 9 months of 2025, net income was $122 million, up from $113 million in the first 9 months of 2024. So overall, their profitability is heading in the right direction. Looks like the increased revenues are translating into higher profits, something investors always want to see. Now let's switch gears and look at their financial health at a specific point in time with their balance sheet. As of the 30th of September 2025, Avista's total assets stood at $8.162 billion, which is up from $7.941 billion at the end of 2024. On the other side of the ledger, their total liabilities were $5.517 billion, and shareholder equity was $2.645 billion. What is interesting here is their debt levels. Their long-term debt is quite substantial at $2.753 billion. While they do have equity to back it up, this level of debt is something we always keep an eye on for companies. Their accounts receivable are down from $205 million at the end of last year to $155 million this September, which is good. It means they're collecting money from customers more efficiently. Inventory is up though from $193 million to $228 million. This could mean they are stocking up for future needs, or perhaps have some goods that are not selling as quickly. It is not necessarily a bad thing, but it does tie up capital. Looking at their other property and investments, we see a slight decrease from $399 million to $364 million. This category includes things like equity investments and seems to have been trimmed slightly. Let's talk about cash flow. For the 9 months ended the 30th of September 2025, Avista generated $394 million from operating activities. This is down from $444 million in the same period of 2024. The report mentions this decrease is largely due to a shift in how they handle power and natural gas cost deferrals. Essentially, they recovered more costs in 2024 and are deferring more benefits in 2025. In investing activities, they used $373 million for capital expenditures, mainly in utility property, which is a significant investment in their infrastructure. On the financing side, they had a net cash inflow of $7 million in 2025, which is a big change from using $60 million in the previous year. They issued more debt and bought back less stock, which tells a story about how they are managing their capital structure. Remember that net income we talked about earlier. For the 9 months, it was $122 million. This is despite a big chunk of cash being used for investments in their property and infrastructure. They managed to reduce their short-term borrowings by $67 million, which is a sign of strong cash management. They also issued $140 million in long-term debt, but paid out $119 million in dividends. So they are managing their debt and returning cash to shareholders. Now let's talk about risks. Like any company, Avista has a lot of things that could go wrong, and they are very upfront about it. They are exposed to utility regulatory risks, meaning decisions by government bodies can significantly impact their earnings. Then there are operational risks like severe weather wildfires and cyber attacks. Wildfires in particular seem to be a growing concern for them, as they mention multiple lawsuits related to fires allegedly started by their equipment. They are also facing climate change risks and increasing pressure to transition to cleaner energy sources. Cybersecurity is another big one, with the potential for disruptions to their systems and data. They specifically highlight that cyber attacks on their operating systems, which run their generation and distribution facilities, could cause serious damage and long-term disruptions. And for their administrative systems, the risk of data breaches and liabilities is also a major worry. Technology is changing fast, and they are worried about their current tech becoming obsolete and the new risks that come with adopting new technologies, especially things like artificial intelligence. They also mention the risk of insufficient technology skills which could slow down their progress. Strategic risks include competition from alternative energy sources and the trend towards customers generating their own power, which could reduce demand for their services. They also acknowledge the risk of negative publicity affecting their reputation and the potential for municipalization, which means local governments could try to take over their operations. Environmental regulations are a huge factor for them, with new laws around climate change, water quality, and waste management constantly emerging. They are also watching out for policy and legislative changes that could impact their business, including potential tariffs on imported energy and equipment. On the financial side, interest rate fluctuations are a constant concern affecting their borrowing costs. Energy commodity markets are volatile and can impact their ability to hedge and their collateral requirements. Changes in pension plan assumptions can also affect their future financial obligations. The volatility in wholesale energy markets is a major risk. They worry about the availability of willing buyers and sellers and changes in prices that can affect their operating income and cash requirements. Defaults from parties they transact with are also a risk. Let's look at how they actually make money. They break down their utility revenues into a few categories. Revenue from contracts with customers is their bread and butter, representing sales of electricity and natural gas to homes and businesses. They also have alternative revenue programs, which are basically regulatory mechanisms like decoupling that adjust revenues to account for changes in customer usage. Derivative revenues are from wholesale energy transactions, and then there is other utility revenue for things like rent and late fees. For Avista Utilities, the core of their business, electric operating revenues are up. For the third quarter of 2025, they were $329 million compared to $316 million in the third quarter of 2024. This increase is attributed to higher retail rates from their general rate cases and more customers using their services. Natural gas revenues saw a slight decrease, but that is mostly due to lower prices adjusted through regulatory mechanisms that don't actually impact their core profits. They talk a lot about utility margin, which is a non-GAAP measure, meaning it is not strictly following accounting rules, but it is how they like to look at their operating performance. Electric utility margin increased significantly by $32 million in the third quarter of 2025 due to those rate increases and customer growth. Natural gas utility margin also ticked up by $4 million. Looking at the 9-month period, electric utility margin saw an even bigger jump of $86 million. This really highlights how those general rate cases are boosting their core profitability. Natural gas utility margin also grew nicely by $19 million over this period. Avista is investing heavily in its infrastructure. They plan significant capital expenditures for the next several years, topping out at around $705 million in 2030, just for their base utility operations. This includes upgrades to their electric and natural gas systems to ensure reliability and meet future demands. It is always good to see what their auditors have to say. Deloitte and Touch LLP reviewed their interim financial statements, and they found no material modifications needed, which is standard but still reassuring. They also confirmed that the balance sheet data for December 2024, which was part of their audited financials, was fairly stated. The management's discussion section points to higher net income in 2025, primarily driven by those general rate cases. However, they also note increased operating costs and a dip in investment gains from their other businesses, which is dragging down overall results a bit. An interesting point they raise is the potential impact of tariffs on imported goods. While they believe it has not significantly impacted them so far, they are closely monitoring how tariffs could increase their costs for equipment and materials. They also mention a new US reconciliation bill, the One Big Beautiful Bill Act that was enacted in July 2025. They expect it to have a minor impact on their financials and tax rate, but are still digging into the details. Their approach to managing enterprise risks hasn't changed much. They are focused on interest rate risks, where they try to limit their exposure to variable rates and manage debt maturities. Credit risk is also a focus, especially concerning collateral requirements for their energy contracts. Should their credit rating drop, they could be on the hook for significant additional collateral. The volatility in energy commodity markets remains a key concern. They are constantly managing their exposure to fluctuating prices and the risk of counterparty defaults. Looking ahead, Avista is preparing for increasing load growth and a shift towards more variable energy resources in the region. They have issued a request for proposals to secure new energy and capacity and are evaluating various projects, including thermal wind, solar, and storage solutions. They also have a commitment to clean energy targets with plans to increase clean energy delivery in Washington. Their natural gas ERP also focuses on meeting emissions legislation through strategies like renewable natural gas and energy efficiency investments. So what is my take on Avista Corporation after reviewing this filing? On the whole, the company appears to be navigating the challenging utility landscape quite well. Their core utility business is showing solid growth, particularly in electric margin thanks to successful rate cases. They are making significant investments in their infrastructure, which is crucial for long-term stability and meeting future demand. However, there are definitely areas to watch. Their debt levels are substantial, and while they are managing it with strong equity and regular issuances, the increasing risks from wildfires and environmental regulations are significant and ongoing. The transition to cleaner energy sources also presents both opportunities and challenges, and their investments in clean tech are currently showing some paper losses. The potential impact of tariffs, although they say it is minimal, now could become a factor. Overall, Avista seems strategically positioned to adapt, but they will need to continue to manage these risks carefully. Alright, that is our deep dive into Avista Corporation's third quarter 2025 report. What are your thoughts on their financial performance and future strategy? Did any of the risks mentioned stand out to you? Let me know in the comments below. If you found this analysis helpful, please hit that like button. It really helps the channel, and remember to subscribe for more corporate breakdowns like this. Also, check out the Discord link in the description. You can join the conversation there with other finance enthusiasts. Thanks for watching Corporate Decoder, and we will see you in the next video.